A stronger jobs number changed the whole read for the week. Welcome back to this week's market recap. The market came into Friday looking for relief, but the labor data did not give buyers an easy path. Payrolls were stronger than expected, unemployment stayed steady, and prior months were revised higher. That shifts the mechanism from recession relief to rate anxiety. If the economy is still firm and inflation pressure is still hanging around, the market has less room to price easy Fed policy. So now the question is not just whether stocks pulled back. The question is whether this is a controlled reset or the start of a real rejection. That is why the chart red matters now. Buyers need to prove support can hold. Sellers need volatility to stay firm. Confirmation matters more than the headline drop. The Dow Jones Industrial Average fell almost 700 points, and that tells us the weakness was not locked inside one narrow corner of the market. Breadth started to matter again. The S&P 500 dropped hard enough to become the broad market decision layer. For me, this is where buyers need to show whether the prior trend is still defendable or whether the market needs a deeper reset. The Nasdaq Composite was hit the hardest, down more than 4%. That is the leadership warning, because if growth cannot stabilize, risk appetite has a much harder time rebuilding. The VIX jumped into the low 20s, and that changes the tone. Volatility is no longer background noise. It becomes the stress qualifier for every bounce attempt. Bitcoin also sold off, and that matters as the speculative risk read. When crypto weakens with tech and volatility rises, liquidity is stepping back instead of leaning into risk. Base case first, if buyers defend support and volatility starts backing off, this can still turn into a relief bounce after a sharp shock. If support fails and the VIX keeps pressing higher, then sellers keep control and the market has to reprice the move. That is why we start with volatility. The next chart is the VIX, and the key question is whether this fear spike is already stretched enough for a bounce, or whether it is confirming a deeper risk-off turn. Volatility is now the first decision point, because last time the VIX was still calm and giving equities room. That has changed. Stronger jobs, higher yields, and sticky energy pressure turned the tape into a real stress test. Jumped about 34% in one session is the shock move. That is enough to respect the sell-off, but I do not want to call it a full regime change from one candle alone. Full fear regime still needs confirmation. For me, fear has to stay bid after the first spike, not just print one violent move and fade. The close near 21 matters because it puts volatility back above the main reference area instead of leaving it buried in the old calm zone. 50 days average is sitting near 19 and the VIX is now above it. That is the first warning that this is more than a normal little uptick in stress. 200-day average is near 18, and staying above that line would make the move harder for equity bulls to dismiss. ATR has not really confirmed the fear move yet. It is still only around the lower quarter of the past year, so the spike is there, but the range expansion has not fully backed it up. High probability bounce watch is the other side of this setup. When VIX jumps this hard, I am watching for at least one relief attempt, not assuming a clean trend reversal in stocks. On the shorter term chart, the VIX is pressing the upper Bollinger Band near 20, so fear is still pushing right now, not cooling off yet. Upper Bollinger Band pressure tells me the spike is stretched, but not automatically finished. Buyers and equities need volatility to back away from that band before the bounce reg gets cleaner. Switching from ATR to MACD, the histogram is expanding above zero, so ATR gives us the range red and MACD says the fear move still has some push. MACD histogram momentum is the confirmation problem for bulls. If that histogram keeps expanding, the market is not done pricing stress. Bounce attempt stays the base case only if SPY holds support and the VIX starts backing off. That would fit the idea of a corrective pullback inside a broader uptrend. Fear is still in control if SPY loses support and the VIX keeps climbing. That would weaken the bounce case and turn the next chapter into a much more important S&P 500 support test. The trade path is still alive, but it is not a clean chase anymore. After the VIX spike, SPY has to prove this is only a pullback inside the bigger trend. The long upper line matters because it has been tested again and again since early 2025. That makes it a real resistance reference, not just a random reaction line. The lower line is newer and steeper, coming off the March low, so it is the support side of the current recovery structure. Let me bring this in a bit. Current price is still inside the structure, so the market has not fully broken down, but it also has not reclaimed the upper side with authority. 50 days moving average has held for 42 sessions, and that keeps the pullback corrective for now unless sellers push through it cleanly. 200 days moving average is still below as the bigger trend floor, so the long-term structure is not the problem yet. Resistance line is the issue. Until buyers reclaim the upper side, I still lean toward rejection first instead of a clean breakout. Support line is the failure marker. If sellers push SPY below that rising floor, the bounce case weakens fast. RSI has slipped below 50, so momentum is shifting towards sellers right when the market needs a stronger close. MACD is fading below zero, and that keeps the chart in a prove-it mode before I call this bullish again. Volume overlay is the caution flag here, because the 5 days average volume is sitting in the bottom 20% of this lookback. Participation is unusually light for a clean reclaim attempt, so the base case is still a bounce attempt if support holds and volatility backs off. If support fails, sellers can press this lower before buyers get another clean shot. Momentum warning is why I do not want to ignore Friday, even though the broader uptrend has not fully broken. RSI divergence is the key signal here. Price made the higher high, but RSI printed a lower high, so upside momentum is fading under the surface. That does not automatically kill the bullish path, especially with price still near the upper decision area. It does mean buyers need confirmation through the close, not just an intraday bounce. If near-term support holds and RSI stabilizes, the S&P 500 can still rebuild toward the next resistance test. If RSI keeps rolling over while price loses support, the pullback becomes the cleaner path first. That is the handoff into QQQ. If the broad market is already showing fading momentum, Nasdaq leadership has to prove it can absorb the same yield pressure instead of leading the next leg lower. QQQ is where the broad market pullback turns into a leadership problem. SPY still has a possible bounce path, but growth has to stop bleeding first, or that bounce gets much harder to trust. Price is still above the major moving averages, so the larger trend has not completely broken. The problem is that the short-term structure is already damaged. Support line is the key failure marker here. Prices stayed below that rising support for 2 sessions, so the breakdown is there, but I still want confirmation before treating it as a full trend failure. 50 days is still below priced and is held for 42 sessions, so buyers still have a trend cushion if this turns into a flush and reclaim. 200-day moving average is the deeper trend floor, and QQQ is still well above it. That keeps the bigger structure alive, but it does not remove the near-term selling pressure. RSI has cooled hard from the overbought push, but it is still above 50. That means momentum is weakening, not fully broken yet. MACD is fading below zero, so the chart needs price confirmation before I can call this a clean bullish recovery. If QQQ quickly reclaims the broken area, this starts to look more like a flush after a crowded run. If it cannot reclaim, the next downside support area becomes the cleaner path, and that would push against the broader bounce thesis. The momentum warning is the reason I am not treating this as just one bad growth stock session. Strong jobs and higher yields hit the longest duration part of the market first, and QQQ is showing that pressure directly. MACD divergence is the key signal here. Price made a higher high, but MACD made a lower high, so upside momentum was fading before the sell-off accelerated. That does not automatically cancel the bigger uptrend, but it does delay the bullish read. Buyers need a reclaim and a stronger close before I trust a move back toward the highs. If support holds and MACD stops weakening, QQQ can still help repair the market. If support breaks while MACD keeps rolling over, growth remains the weak link, and that takes us straight into the 10-year yield because rates are the pressure point driving this chapter. The 10-year yield is the pressure point behind the QQQ damage. Stronger jobs gave rates a reason to reprice higher, and as long as this trend stays firm, growth stocks have less room for a clean recovery. Golden Cross is the broader regime signal here. The yield trend still leans higher, so equity bulls need rates to cool, not just pause for one session. SMA 50 has been above the long-term average for 49 days, and that keeps the shorter rate trend in control. SMA 200 is rising underneath, so this is still a healthy yield structure rather than a broken one. Current price is about 8% above the 200-day line, which tells me the move is strong but also stretched enough to watch for a pullback. So the market can still bounce if yields stop pushing, but the bullish equity red gets harder if this rate trend keeps extending. The tactical read is continuation first, not rejection. That matters because if TNX keeps pressing higher, the rate pressure story stays in control of the next equity move. Price is above both key averages, so the chart is not acting like a failed rate move yet. Resistance line is the breakout trigger. Price is closing above that short resistance line for the first time, so sellers and bonds have not taken control back yet. 50 days has held for 61 sessions, and that makes it the first trend cushion if yields pull back. 200 days moving average is the deeper floor, so the larger yield trend stays intact unless sellers push much harder. RSI is above 50 and rising, which keeps short-term momentum constructive for yields. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. If TNX holds above this breakout area, continuation higher stays the cleaner path, and that keeps pressure on growth. If it falls back under the breakout, the move starts to look like a failed break, and risk assets get some breathing room. That is why crude comes next. Oil is the inflation input that can either keep feeding this yield move or finally take some pressure off the rate story. Crude is still the inflation pressure valve, but the chart is not giving a clean upside confirmation right now. After the yield chapter, this matters because oil can either keep rates under pressure or finally let the macro story cool. Golden Cross is still active, so the bigger crude structure has not flipped into a confirmed bear trend. SMA 50 is still above the long-term line, but price is trading below it, and that is the short-term problem for oil bulls. SMA 200 is still rising underneath, so I treat this as correction risk inside an intact, broader uptrend unless that deeper line starts failing. Current price is below the 50 days area, so buyers need to reclaim before I call this a clean continuation setup. The macro link is direct. If geopolitical risk keeps crude bid, inflation pressure stays alive, and the rate story stays harder for equities. If crude keeps fading, the market gets some relief before we move into the AI leadership stress test. The tactical oil red still leans rejection first. The market is sitting in the middle of the structure, not at a clean breakout point, so I want price to prove the reclaim before giving crude the benefit of the doubt. Price is below the 50 days moving average but still above the 200-day, so the short-term read is softer while the larger trend is not fully broken. 50 days moving average is the first reclaim level. Until crude gets back above that area, rallies can still get sold. 200-day is the deeper trend floor, and staying above it keeps this from becoming a full trend reversal. Resistance line is the upside test. A clear reclaim through that structure would flip the read away from rejection and back toward continuation. Support line is the downside checkpoint. If sellers press crude lower from here, that lower boundary decides whether the pullback stays controlled. RSI is still below 50 and fading, so momentum has not repaired yet. MACD is fading below 0, which keeps the chart in improvement mode before I call the oil bounce healthy. So the clean read is this: oil weakness can ease part of the inflation pressure, but a sudden reclaim would bring that pressure right back. That is why the next chapter moves to Nvidia, because growth leadership has to stabilize while this macro tension is still unresolved. Nvidia is still the AI leadership anchor, but after oil and yields kept macro pressure alive, this is no longer a clean chase setup. The trend is strong, but buyers need to prove the sell-off is a reset, not a leadership failure. Golden Cross is still the bigger regime signal, so I'm not calling NVDA broken just because volatility hit the tape. SMA 50 has stayed above the long-term average for 237 days, and that keeps the medium-term leadership structure intact. SMA 200 is still rising below price, so the deeper trend floor has not been damaged yet. Current price is still about 9% above the 200-day line, which tells me the trend has room, but it is not cheap support anymore. So the bullish side still has an argument, but the edge is conditional. If NVDA stabilizes, it can help repair the broader market read. If it keeps fading, AI leadership stops cushioning the pullback. The tactical read is the real stress test. NVDA is sitting right where buyers need to respond, and I still see this more as a bounce zone than a clean breakdown for now. Price is sitting near the 50 days area, and that line acted as support today, so the first question is whether buyers can turn that reaction into a reclaim. 50 days moving average is the immediate cushion. If price holds around it, the pullback can still stay corrective. 200-day is the broader trend floor, and staying above it keeps the larger AI trend from turning defensive. Support line is the warning. Price is closing below that rising support for the first time, so bulls need a quick reclaim or the damage starts to matter. Resistance line is the upside test if NVDA bounces. Reclaiming back into that upper structure would make the sell-off look more like a failed breakdown. RSI has slipped below 50, so momentum is shifting towards sellers at exactly the point where buyers need confirmation. MACD is fading below 0, so I need price confirmation before treating this as a clean bullish recovery. If NVDA reclaims the broken area and holds into the close, it helps the broader bounce case. If it closes cleanly below support, the AI trade becomes part of the risk problem, and Microsoft has to show whether mega-cap growth can still stabilize the tape. Microsoft is the mega-cap growth check after the Nvidia stress test. The issue is not whether software leadership matters. The issue is whether MSFT can hold structure while yields and volatility are pressuring the whole growth trade. Long-term chart is the warning here. Price has just slipped below an 8 years weekly log channel, so this is not just a small short-term wobble. Close below the long-term channel is the break that gets my attention, but I do not treat the first close as the final answer. Lower rail near 420 is the decision level now. Price is only about 1% outside the channel, so the next test is whether buyers can reclaim that area fast. Falling back inside would turn this into a failed breakdown, and that would help the broader bounce case. If it stays outside, MSFT becomes a problem for mega-cap growth. RSI gives us the stretch read first, and it is not showing a clean panic washout yet. Let me quickly switch to MACD. Momentum is still above 0, but it is starting to shrink, so the downside break still needs confirmation. MACD is the confirmation check. If it keeps fading, the breakdown gains weight. If it stabilizes, the failed break path stays alive. Volume overlay matters here because participation is unusually strong on the 5 weeks average. That makes this break harder to ignore, even if the reclaim path is still possible. The tactical read leans bearish until MSFT proves otherwise. This is still one of the names that could stabilize the market, but the burden is now on buyers. Price has reclaimed the 50 days moving average, so the stock is not fully broken on the near-term trend red. 50 days moving average is the first support cushion, and holding above it keeps the flush reclaim scenario alive. 200-day is still overhead, and that is the bigger trend test buyers have not solved yet. Support line is the problem. Price closed below that rising support for the first time, and the old support is starting to behave like resistance. Resistance is now the reclaim test. If buyers cannot get back through that broken area, the bearish read stays in control. RC has slipped below 50, so momentum is shifting towards sellers right when MSFT needs to act like a stabilizer. MACD is fading below zero, which keeps this in prove-it mode before I can call the recovery clean. Volume overlay confirms participation here, with the 5 days average volume in the top 20%. This was not a light volume shakeout. If MSFT quickly reclaims the broken area, the move can still look like a flush and help the broader market repair. If support keeps giving way, the next downside focus shifts toward the lower support area around 406, and the calendar chapter matters because the next macro events can decide whether buyers get relief or more pressure. Now the calendar is where this whole setup gets tested. After Microsoft showed stress inside megacap growth, the market needs macro relief, not another reason for yields to stay firm. Wednesday, June 10th brings the CPI cluster, headline CPI month over month and year over year, plus core CPI month over month and year over year. This is the inflation test for the bounce case. If CPI comes in hot, rate pressure can stay in control, and growth stocks may have a harder time repairing. If it cools, buyers get a cleaner shot at stabilizing risk appetite. Thursday, June 11th, follows with producer prices ex food and energy year over year. That is the pipeline inflation check, and it matters because sticky input pressure can keep the Fed path tight even if equities try to bounce. If that producer price read stays firm, I would expect yields and the dollar to remain important pressure points. If it softens, the market gets more room to treat this pullback as corrective. Friday, June 12th brings Michigan consumer sentiment. For me, that is the demand check after a week where jobs looked firm but risk appetite weakened. The clean path is cooler inflation with steady sentiment. The warning path is sticky inflation, firm yields, or a weaker consumer read because that keeps the retest risk alive into the next tape. The full read is still constructive, but it is not a clean chase signal anymore. Again, the market is strong enough to keep buyers in the conversation, but Friday proved the close matters more than the intraday push. RSI at 49.3 is not extreme, and that keeps the pullback from looking washed out yet. Open gap below around 725 to 727.8 is still unfinished business, so this is not a clean upside story without confirmation. Again, stronger jobs, sticky energy pressure, and firmer yields do not replace the chart. They change the probability around the next decision area. Overhead decision zone near 746.3 is where buyers have to prove this is still controlled digestion and not the start of a larger stall. RSI at 49.3 also says momentum is balanced, not washed out, so I would not blindly chase a bounce without a stronger close. Open gap below around 725 to 727.8 could still pull price lower first if sellers press and buyers do not respond quickly. Again, the warning from last week was about needing confirmation through the close, and that is still the right lens now. From here, I am moving this into the thesis map I am tracking next, because the decision is about confirmation, not just direction. Main setup still favors the broader uptrend staying intact, but buyers have to hold control near the upper decision area and stop the pullback from spreading. Overhead decision zone near 746.3 is the first line in the sand for that bullish push. If buyers can push into that area and avoid getting sold right away, then the rally structure can start repairing. Secondary resistance cluster near 761 is the next overhead test if the first resistance area gets absorbed cleanly. Larger upside objective would only start to come into view up around measured move target at 804.8 if buyers keep control and extend through those resistance checks. Again, that target is not active just because it exists on the map. It needs a confirmed hold and follow through above resistance. Risk alternative is that price cools off first before buyers get a better shot at reclaiming the current area. Open gap below around 725 to 727.8 is the first magnet I am watching if sellers keep pressure on the tape. Risk alternative becomes more important if that gap starts filling instead of price stabilizing quickly. Main setup stays healthier if buyers defend the nearby stabilization area and volatility backs off instead of confirming stress. Overhead decision zone near 746.3 is still the level that has to hold after a reclaim, not just get touched intraday. RSI at 49.3 means this can still reset without breaking, but buyers need momentum to stop rolling over. Again, as long as buyers keep the breakout structure alive, I treat pullbacks as corrective first. But if price loses the breakout structure instead of holding above that upper decision zone, the bullish read weakens and the support reset becomes the cleaner path. Do we get the gap and go, or do we fill the gap first? That is the whole decision into the next tape. That is the full weekly market recap for June 1st through June 5th. Watch whether buyers can defend the pullback, respect the gap risk underneath, and let the close confirm the next move before chasing. Thanks for watching, stay sharp, and I will see you in the next market recap.